Looking for a retirement podcast that covers all aspects of retirement planning? Well, look no further than this podcast. Hosted by me, Nestor Vargas, a certified financial planner, knowledgeable and experienced Latino financial advisor. Each episode features in-depth discussions on a variety of topics, including retirement planning strategies, investment options, tax considerations, Social Security, healthcare planning, and much more. But I also will add a unique twist to the show. Occasionally, I will dive into the considerations U.S. citizens should make when thinking about retirement abroad, exploring different destinations and lifestyles that can be affordable and enjoyable during your golden years. With my extensive knowledge and experience in retirement planning, you'll get the information you need to make informed decisions about your future. So whether you're a Latino looking for retirement planning tips from someone who understands your cultural background, or just someone who wants to learn more about retirement planning, this podcast is the perfect place to start. Tune in today and let's start planning for your retirement with confidence. Whether you are retired or nearing retirement, it's natural to want to feel secure about your financial picture. But what happens when that security is threatened by an unexpected event, like the government shutting down or bank failures? Join me in this episode as I discuss how these events could impact your retirement life. This is your host, Nestor Vargas, certified financial planner and your Latino money man. Welcome back to another episode of the Green Cards to Greenbacks podcast, sponsored by Green Mountain Planning, where I help individuals over 50 retire with ease and confidence, and where Latinos can find someone who understands their cultural background. Before we dive into the episode, I want to start with a joke. What's the only thing a Latino has when he's scared? Hispanic. Alrighty, that's like I said, I'll be here all day long with this jokes. I hope you're enjoying them. But let's go ahead and dive into really the meat and potatoes of the episode. Okay, so let's go ahead and get started with the recent bank failures, and let's talk about what happened. Okay, so the most recent bank failure was Silicon Valley Bank, who did mainly business in, you guessed it, Silicon Valley with tech startups. And what happened is that financing started to dry up for these tech startups. And obviously, like any company, you still have to pay your bills. And so naturally, the tech startup companies had to rely on their cash reserves, so started spending their savings at a rate that the bank had not anticipated. And so it really put the bank in a really hard position, because the bank doesn't just sit in cash and not have their money invested, right? At the end of the day, the bank is trying to make money just like you are. And so they don't just keep your money in cash. They invest it. It made the bank sell investments at the wrong time, causing them to lose money. That, along with the kind of other clients who got scared and started to withdraw money away from the bank, proved too big and too much for the bank to be able to bear. So the bank failed. And luckily, the FDIC stepped in and actually made all depositors whole above and beyond the regular insurance. Now, what's happening also is that other banks, like small regional banks, are feeling the same issue. There are people withdrawing their money from the banks, and at a rate that they were, again, not expecting, that really hadn't been seen in a really long time. And it's really put in this smaller banks in a position where they just have to find a new home. They have to find a bank that's better capitalized to be able to exist. So now that we understand what really transpired in the banking system right now let's really discuss the debt ceiling issue. Okay, the debt ceiling is a limit on the amount the U.S. government can borrow to pay for its expenses. Once the government hits that debt ceiling, it can no longer borrow money unless more money is raised. Okay? Now, if the government can't borrow money and doesn't have enough revenue coming in, then it may not be able to pay its debt. and we'll have to default on the debt, which is no good for the US economy or really any particular global market. It would be catastrophic, frankly, if that happened. So let's kind of talk through this, conversation about the debt ceiling. Because I'm really getting a lot of questions from clients, and I got to think that you're also kind of worried about this or want to know more about it. So during the last government shutdown, okay, this is where the government basically couldn't agree, kind of where we are right now, where they're debating, couldn't agree on something. And so we hit the debt ceiling. We actually hit it. The government had a shutdown. That was in 2018, 2019. And during that event, the S&P 500 lost about 10% from its peak, okay? In September of 2018, that's where it peaked to its low point late December. Now, the decline was attributed to obviously this issue that happened with government not being able to get it together, but also we were having issues with the trade war with China, and the economy was slowing down. So there's never an event that happens in isolation, right? The market there's just too much going on. But I think one of the biggest triggers was that the government shutdown. Now here's the deal: after the government shutdown ended in late January of 2019, the S&P 500 index rebounded, gaining over 7% in the month following the end of the shutdown. So yeah, there was some volatility, but it wasn't something that was catastrophic, is what I'm trying to say. So now, what consequences can we expect these events to have on our retirement? And if you know me, you know that I always like to zoom out to get a better perspective. And that's exactly what I'm going to do today by sharing this chart. So if you are listening to this and not watching this on YouTube, I'm going to do my best to explain to you this chart, but you'll also have access to the chart by going to the show notes, greencards2greenbacks.com, clicking on the archive button on top of the page and finding this episode. Or you can just head over to YouTube and Google Green Cards to Greenbacks and actually see me recording this episode that you're listening to live. Alrighty, so let me go ahead and share this screen. And for you who are listening, I'm going to do my best to describe what I'm showing. What I'm showing right now is, I guess, let me kind of just say what I want you to take away from this chart before I even describe what you're seeing, is that financial crises, bank failures, and U.S. stocks have happened. I'm going to show you these events have actually happened in the last 40 years. These challenges will continue to happen, but what has happened is that really the market has continued to be resilient. The chart that I'm showing you, and for you listeners, I just picture it as a chart of years at the bottom from 1980 to now, February of 2023. Okay, so that's the bottom axis of the chart. And the other axis is how much money $100,000 would have grown. And this is in the S&P 500. Now, the reason I chose this particular time frame is because it does show a few debt crises that happened in the past 40 years. The Latin American debt crisis in 1982. I wasn't born, but I learned about it. And then we also had the late 1980s, early 1990s bank failures. There's over 1,000 banks and credit unions that failed here in the United States. We also had the Asian debt crisis in 1997, 1998. And then we also obviously had the financial global crisis in 2007, 2008, which is really not the same as what we're dealing with today. Our situation is much different. But in that 1980s to early 90s, where there was all this bank failing, if you actually could see this chart, well, you who are on YouTube, you're seeing it. You see that there was a decline that was very little. It was maybe a decline of maybe, I don't know, call it a year, where we went into this little recession. That was it. What is really most impactful, and what I want you to take away, is that had you had $100,000 in the S&P 500, January of 1980, and not touch that money, those $100,000 in 40 years would be worth $11.26 million, which is just astronomical. My point being is that, yes, we are going to see scenarios that cause the stock market to decline temporarily. But the market is resilient. We as investors are resilient. We innovate and we get through this tough times that happen. And there is no, there's no like this doomdays thing. One of the most, I would say, dangerous words that you can tell yourself is that this time things will be different. That this time the market will not continue to grow. That we won't continue to innovate. Those are the most dangerous words that can get into your head. Okay. So I hope this chart was helpful. Okay. And so while things, worked out really nicely for those disciplined investors over the past 40 years, I actually would be naive not to point out that the fact that there needs to be a strategy set in place to deal with this, recessions that we'll see, right? Like, no one likes to see their portfolio drop in value, including me, but, no one who's retired or about to retire feels really good about it either. So what is this strategy? What can we do? Really, my idea is that you have to have a war chest in your portfolio, and you need to know what your bottom guardrails are for your income. So let's discuss a war chest. To me, a war chest is money sitting in much more stable investments than the stock market, so you can rely on them heavily during a down market, during a recession. It's a prolonged periods of negative returns. You don't want to sell stocks when they're down, right? And so what do? You go into your war chest. And typically, 2 to 3 years worth of expenses is enough to have in a war chest, more or less, depending on how much of your income in retirement is going to be coming from reliable sources of income, righty? Now, to further manage the risk of, ultimately what people get worried about it is that you're going to run out of money, right? Or that you're not going to have enough money to retire. To further manage that risk, you should have a really clear understanding of how much your portfolio can drop by before you have to cut your income, right? That is called your bottom guardrail. And that guardrail is there to keep you from overspending your portfolio, really during times of crises, but also really during the regular market. You got to know what sustainable withdrawal rates are based on the current economic environment. So in summary, what we have discussed in this show is that we have been through financial crises before. Banks have failed and the market continued to innovate, continued to grow. We have been through an actual government shutdown before, not too long ago, and it wasn't catastrophic. So here's my advice to you. Stop acting surprised when the stock market drops in value. I mean, that's really just part of the deal. Instead, make sure you have a war chest, fully funded, and have a clear understanding of what your income guardrails are. As always, if you have any questions or would like to discuss your retirement planning needs further, please don't hesitate to reach out. Thank you for listening. Let's go make those greenbacks. Bueno pues, I hope you guys enjoyed this episode. I want to go ahead and ask you to please send me any questions you may have or any topics you want me to talk about. Go ahead and send them to Nestor, Nestor, at greencardstogreenbacks.com. I actually read every email you send, so I'd love to hear from you. Don't forget to head over to greencardstogreenbacks.com for the show notes for this episode and really links to any resources we may have discussed. Bueno, amigos y amigas, nos vemos pronto. Let's go make those greenbacks. This is because of lawyers. You should consult a financial advisor who's familiar with your specific circumstances and of your unique financial life before making any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mentioned rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Nestor Vargas is an investment representative advisor of Green Mountain Planning, a Colorado registered investment advisor.